I hope we have time in this interview to talk
Oh,
about silver.
We're
because
talking. That's my next question.
I'm becoming much more bullish about that trade.
Well, let's change the subject then. I have those questions ready too, because we are Wall Street Silver. Here's the latest chart from your favorite guy on Reddit, Ditch the Deep State. He has stopped including the gorilla picture at your request, by the way. But we see PSLV. PSLV is, of course, the silver equivalent of the Sprott Uranium Trust. It's the Sprott Physical Silver Trust. And it's basically sort of leveled off, you can see, the past 2 months. It still is going up a little bit. There are some additions occasionally, but it's not what we were seeing earlier in the year and up to the middle of the year, where Sprott was just vacuuming up everything. And COMEX registered silver was declining so much. What have you seen change in the market the past 2 months?
I think people got tired of the silver narrative.
Mm-hmm.
And I think, too, that there was substantial demand in the silver space around what has been described as the silver squeeze, which is to say a circumstance where if enough people bought physical silver, that the systemic imbalances in the silver market, which is to say the dichotomy between COMEX volumes and physical volumes, would collapse, but also where the structural shorts would get trapped. To me, that was never the silver squeeze, never the silver squeeze. I was interested in how much that silver squeeze changed the dynamics of the silver market. I've told you before the surprise that I felt when institutions like Sprott, the largest physical, good delivery silver buyer in the world, began to experience difficulties acquiring silver. And I think it's changed the dynamic of the market too, because I think that the risk officers around the big banks view the silver trade and the COMEX trade very differently than they viewed the market a year ago. But I don't think that's the big story in silver. I think the big story in silver is that the real silver squeeze will occur when the fundamentals, not the market structure, when the fundamentals behind precious metals, we've recited them before, quantitative easing, debt and deficits, and in particular negative real interest rates, cause generalist investment demand for precious metals to itself cause the market share of precious metals relative to other investment and savings classes merely to revert to mean. Let's look at this arithmetic again. Precious metals and precious metals related assets comprise less than 0.5% of total savings and investment assets in the United States. Wow. The silver squeeze notwithstanding. Okay. Mm-hmm. The 3-decade mean is between 1.5% and 2%. And it's estimated that in 1980, 1981, the same number was above 5%. Yeah. I'm not talking about taking out the old highs in terms of market share, although that could occur. But if we revert to mean over the next 3 to 5 years, which I absolutely believe we will, demand for precious metals and precious metals related investments in an economy that is 23% of the world's savings and investment assets will triple. Mm-hmm. Now that's a silver squeeze.
Yeah.
That is a silver squeeze of an order of magnitude and dimension that would, I think, exceed the wildest dreams of the Reddit crowd, however wild their dreams have been.
They're pretty wild.
It'll happen for different reasons. And I'm not discrediting the Reddit crowd at all. They taught an old man something, which is to say that float and stock, that is to say market structure, is a fundamental. I hadn't understood that until I was 68 years old. And I was taught it by some 19-year-olds. Mm-hmm. But there's a different type of fundamental too, which is to say greatly more demand than supply. And if precious metals markets merely revert to mean, they don't have to take out the old highs, merely revert to mean, demand triples. The second thing I want to say about silver, past does not have to be prologue, but it's a wonderful indication of what happens. In the past two precious metals bull markets that I've lived through, 1970 to 1981 and 2000 to 2011, those bull markets were characterized by a few things. Climbing out of nowhere, just like this one did 3 years ago. Big cyclical declines in secular bull markets, like we've seen. Markets off 20%, 25%. Hell, in 1975, the precious metals market was off 50% in one year before dramatic recoveries. But importantly, as silver is concerned, in the second half of bull markets, silver leads gold. It rises further, it rises faster. By my count, we're 3.5 or 4 years into what I think is likely a 10 or 11-year bull market in precious metals. So we're coming into the latter half. And if you look at what happened in the latter half of both bull markets that have happened in my career, silver really truly came to light. The third thing that's important is the scarcest asset class in precious metals investing are high quality silver stocks. The population of them and their combined market caps relative to the market at large are sort of like a pimple on a blue whale. Doug Casey suggests that when generalist money comes into an asset class as small as the silver equities market, that it's analogous to trying to siphon Hoover Dam through a garden hose. And I've experienced this, in the building of Silver Standard and Pan American Silver, the silver companies that I was involved in early on. We saw moves from 50 cents and 72 cents respectively to over $45. Now, this wasn't market sentiment. These were extremely well-constructed businesses. But it says something about the capacity that the silver equities have to surprise people in the second half of a bull market.
Do you see any more near-term downside to silver? I mean,
Sure.
a lot of people,
Absolutely.
are concerned.
Yeah, absolutely. I hate to be so philosophical in this in this talk, but the truth is I'm probably triple the average age of your listener. So maybe I've earned the right to be philosophical. People don't often have enough courage in their convictions. That the fact that they believe in something can be knocked out of them by a 5% decline in the market quote. What's odd to me is now that I'm 68 and I have much less time left on earth, I'm much more patient. I have learned in my life that money is made in 5 or 6 year timeframes, and that people who don't have the courage of their convictions to hold over a long weekend become my natural and normal victim. They can be right, but if they require immediate price action to calm their nerves or justify their position, they're going to get shaken out of their position. That's unfortunate, but it's true. Could the silver price go down to 20? Absolutely.
Don't say that, Rick. You'll break our heart.
No, don't be using any clickbait like Rick says silver's going down to 20. But when people say, could it happen? Sure, absolutely it could happen. But you have to pay attention to the fact that precious metals bull markets are traditionally a very long duration, 10 or 11 years. We're 4 years into this one. And precious metals bull markets are of substantial dimension too. When I'm talking in public Q&A forums and people say to me, well, Rick, the gold price has already gone from 1,000 to 1,800. Did I miss the boat? And, I have to dust, sort of the accumulated weight of my years off me and say, well, in my first bull market, the gold price went from $35 to $850. My second bull market was tame. The gold price went from $253 to $1,900. For me, in terms of dimension, the move from 1,000 to 1,800, well, it's relevant, isn't particularly interesting.
Well,
am I saying that gold is going to go to $5,000 and silver is going to go to $200? I don't know. When people ask me where it's going to go, I say likely higher, and the silver equities likely much higher. Will that happen in 12 months? I don't have an earthly idea.
Well, you're making fun of your own age being 3 times larger, but just so you know, our YouTube analytics shows that our audience
Uh-huh.
is 90% male, and over 50% is 45 or older. And 80% of our audience is 35 or older, and very high income. So we're not, just so you know, our audience on YouTube, I don't know about Reddit or other places, but the audience on YouTube is not 3 times younger than you. So feel good about that.
Clearly it's a lousy dating site.
Yeah, Wall Street Silver is not known as a Tinder alternative. So demand for silver is roughly 1 billion ounces a year, and supply from the mines is roughly 800. Keith Neumeyer says 750, but maybe 800 without COVID, 800 million ounces, and then the recycling is whatever. No one really knows. But there's this sort of supply deficit going on still. And it doesn't really seem to be reflected in the price. Any sort of thoughts on that?
Yeah, the elephant in the room for 40 years has been above ground inventory.
Yeah.
Particularly above ground inventory in South Asia. I remember back in the mid 90s, silver was in the doldrums, and then Buffett announced that he'd acquired 15% of the reported above ground supplies of silver in the world.
Huh.
And silver went on a tremendous tear, and then collapsed. And everybody was saying, oh, well, this is manipulation, this is shorting, this is all that kind of stuff. There may have been some of that, but what it really was a currency collapse in India. The rupiah fell 50% against the US dollar, which doubled the price of silver in Indian terms. At the same time, where India experienced a poor harvest, the Indian rural peasantry, who didn't trust their government, so wouldn't hold money in rupiah, had traditionally held money in silver because they couldn't afford gold. And they had a choice between feeding their kids or continuing to hold their silver.
Mm-hmm.
Yeah.
They made the right decision. Silver tripled in US dollar terms, and the US dollar doubled in rupiah terms, which meant that in 12 months, the price of silver increased 6-fold in rupiah terms at the same time that the savers had a need of their savings. I'm pointing that out not to teach somebody history, but rather to say that the elephant in the room is above ground inventory that by its nature was not meant to be disclosed and is not known.
There's I've read stories that in 2011, when we made our last run to 49, a lot of grandma's candlesticks probably got melted down during that bull run. And
one of the things that I think, and I don't have experience with this, but I've been talking to as many people as I could who are new to the silver narrative. And I think that I think a couple things. I think if the so-called Silversqueeze is introduced, let's say 1 million people to the narrative, half of them are going to leave. This is not GameStop. This is not AMC. But half of them are going to stay. Half of them might be attracted to the near-term move in silver and then involve themselves in discussion about why silver is an effective savings instrument. And I think that group of people won't have the same pressure to sell that Indian peasantry had during a crop failure. Perhaps they will if silver goes up in nominal US dollar terms 6 times. That is to say, if the price goes from $25 or whatever it is to 150, 175, maybe we'll hit some selling. But one of the things that you're observing it in the uranium market right now, is that as the price goes up, and you would expect increasing prices in the near term to stimulate more supply, it in fact sterilizes supply because greed takes over. That very price action in the near term makes people more covetous of the material. And I think that silver has the ability to surprise us on the upside, not necessarily because of the structure of the market, but more because as more people become conversant with the dangers inherent in other savings products, the more appropriate precious metals become as a unit of savings.
Gotcha.
When your audience begins to look at the arithmetic of the world's premier savings product, which is the US 10-year Treasury, It pays 120 basis points in interest in a currency that the government itself acknowledges is being depreciated in terms of purchasing power by 5% a year.
Yeah.
What that means is that if you hold your money in US 10-year treasuries, the world's preeminent savings product, you are guaranteed a loss of 3.8% a year compounded. That doesn't seem to be to me like a very hard bogey for silver to beat. And that's why I keep saying that I believe that demand for precious metals will revert to mean, which means that demand for silver, among other asset classes, will triple.
With all the fundamental news out there from a fundamental standpoint, whether it's inflation, whether it's just the Fed printing, expanding their balance sheet, all the craziness going on in the world, is there some trigger you think that we need to sort of wake people up to silver and gold, or have we just not had that fear? Is it a fear moment? Does there need to be a fear trade?
Absolutely a fear trade.
Yeah.
Absolutely a fear trade.
And so the next question is Evergrande in China perhaps that credit crisis?
No, I don't think so. I think our crisis in the United States will be homegrown. Chinese manufacture a lot of stuff for us, but they don't need to manufacture terror. I think the simple, slow realization that conventional savings products are, to quote Franz Pick, certificates of guaranteed confiscation. Remember that we've lived through 40 years of the most benign economic climate in human history. The interest rate on the US 10-year treasury has declined from 15.6% to 1.2%, which means that the bond market's been in an absolute tear, and the cost of capital has been spectacularly low. That party by necessity is coming to a halt. It won't come to a halt quickly, and the confidence that was engendered by 40 years of benign existence won't end easily either, but it will end. People can add and subtract. People who take their family out to dinner that used to spend, $150, $200 at a, moderately priced place to take their family out of dinner, now are getting a bill for $375. They're going to the gas pump and they're seeing the price of a tank of gas doubling in 12 months. Heaven forbid they see their tax bill next year. The idea that they don't include taxes in the cost of living is always something that's baffled me, because it's certainly a big component of my cost of living. But I think that there's going to be a gradual realization that people need to reformulate their savings and investment plan. And the consequence of that is that precious metals will take a more prominent position.
So just the other day, we had the CPI inflation numbers. It came in at 5.3%. There's been a lot of criticism, that what they do with food and energy and the way they massage the housing shelter owners equivalent rent portion of that number just seems completely fabricated. But let's toss aside for a moment how fake the CPI number is. It's how the Fed reacts to it that I think people are most thinking about right now. Do you have any opinions about the Fed taper, whether that's off the table, on the table? What do you think? I mean, I know you're not a voting member of the Federal Reserve Board, but what do you think they're going to do?
It seems like my nomination to the Fed went unnoticed.
Yeah.
I think the Fed's reaction is one thing, and I think it's interesting. I think the Fed hopes it can taper. I think that the Fed hopes that they can take the yield on the 10-year to 2 or 2.25. The reason is that if they experience an economic hiccup, they want to be able to lower interest rates again. Yes. And it's tough to lower them from zero. A much more interesting reaction will be the reaction from common people as they come to realize over time that their savings account is being drained. I agree with you that the CPI number is one of the oddest fictions present. When it becomes anomalous, they kick out food and fuel. Well, that's okay. But as people can tell, I like to eat and I drive. Uh, the idea too that they make hedonistic adjustments for living standards, which is to say a house is nicer than it used to be, but those less nice houses aren't available anymore. So people aren't able to unadjust hedonistically.
Yeah.
But the strangest of all fictions to me, Jim, is the fact that the consumer price index, which is meant to be a cost of living index, sort of, doesn't include tax.
Mhm.
I guess if I didn't have to pay the tax, I wouldn't complain quite so much about the issue. But I don't think that's on offer. And I think that if you add the growth in government debt, which is a latent tax, to the tax that we're charged, to the very real escalations that we're seeing in various components, particularly relative to the interest rate that savers are being paid on their accumulated wealth, that behaviors are going to have to adjust. Think about somebody with a passbook savings deposit account. They're getting 25 basis points. They're getting 0.25%. The depreciation in the currency every 2 months, hell, every month, is using up the interest that they receive on an annual basis.
Yeah, that's true.
How long will savers be able to afford that?
Yeah.
If you have your money in a passbook savings account, you are losing 5% a year compounded. Take an amount of money over 5 years and take 5% compound annual losses. What you find out is that inflation stole 1/3 of your retirement after 5 years.
Brutal.
Eventually, this simple arithmetic will come to be understood among savers and investors in the United States.
Well, I think that's probably why they were trying to do Common Core math so that Americans would be less mathematically able to figure these things out. Final question, just to wrap this up. If the Fed were to taper, like they're technically verbally at 120 billion right now, what a lot of people have been speculating is, all right, as soon as they actually taper, market's probably going to have a fit and some sort of 10% whatever decline, hiccup, whatever. And then the Fed will immediately turn around and right back to 120 billion or even higher. We got so much in, 3 trillion deficits and another 4.5 trillion in infrastructure spending and 7 trillion in debt rolling over. Someone's got to buy it. But if the Fed were not to be able to taper, boom, is their credibility gone at that point? I mean, I would think that if they can't even reduce it a little bit, what happens?
If the faith in the Fed put goes away, I can't tell you what will happen.
Yeah.
Well,
again, let's wildly speculate. I want you to wildly speculate.
Yeah, I mean, again, to quote Doug Casey, I'd be really interested in watching it, probably from far away on a broad screen TV.
Well, you are on an island, aren't you?
I am. I am. It really is interesting. I don't think that there is room in the economy as it's currently constructed for market rate interest rates. If you really want to do a scary revert to mean exercise, traditionally the US 10-year Treasury has provided a 1% real rate of return. If the CPI stated rate of inflation is 5.5%, that means that the real interest rate on the US 10-year Treasury would be 6.5%. So imagine the impact on federal, state, and local governments if their interest charge went up 4-fold. If you want to get scarier still, traditionally, the US 30-year mortgage rate has been priced at a premium to the US 10-year interest rate. So let's just say for fun that the CPI stated rate of inflation is 5.5%. Therefore, the mean expected yield on the US 10-year Treasury is 6.5%. And let's say that the 30-year fixed rate went to 7.5%. Can you imagine the impact of a tripling of the 30-year fixed rate on single family housing?
It'd be great. Yeah, I mean, well, hey, millennials would finally be able to afford their first home because the prices would come down so much.
The prices would come down. Of course, what has happened for the last while is that Fannie Mae and Freddie Mac have owned the house and you've rented it from them for 30 years.
Yeah.
The rent would go up in the sense that the interest rate would go up. But I think that the principal would come down. Now, of course, everybody's for affordable housing, but nobody wants their house to become affordable. They want the price of everybody else's house to fall.
Yeah.
And I think the political hue and cry around market-based interest rates would be, let's be polite and say interesting. I've lived through it before.
Yeah.
We had this guy who came out of nowhere, Paul Volcker, who said, I'm going to end inflationary expectations. And he took the yield on the US 10-year from something like 5.5, all the way up to 15.6. And for those of your listeners who don't remember the early part of the decade of the 80s, they were brutal.
Mm-hmm.
They were necessary, but they were brutal. The difficulty they have doing it now is that the dislocations in the American economy, the amount of debt, the amount of flex left in the economy are less now than they were then. So I think that the impact would be even more interesting now than it was then.
Well, we don't even really have a Paul Volcker remaining in the Fed. I mean, that personality, that mentality has been bred out of the current generation of PhDs that inhabit those ivory towers. Is there any scenario where the current Fed board members would ever, I mean, it's hard to, theoretically, the way you stop inflation is you got to raise short-term interest rates above where the current inflation rate is.
Correct.
So, all right, they're admitting to 5.3%, 5.4% the past couple of months. Shadow stats tells me 12 or 13%. I mean, no one's even talking about raising the Fed funds rate to, 15%. I mean, that's like Armageddon with this level of debt. I mean, is that even, how do we stop inflation if it really gets going if the Fed has to, even with their massaged hedonistic numbers, we start seeing 7, 8, 10%. How do we stop it?
I don't know.
Yeah. That's what everyone says. So I ask that question on every interview. That's what everyone says.
A similar question is, how do we manage debt at a federal, state, and local level?
Yeah.
If you look at the on-balance sheet liabilities of the U.S. government, they exceed $29 trillion now, 22 net of the Fed's own balance sheet. But much more concerning are the off-balance sheet liabilities. Medicare, Medicaid, Transportation Trust Fund, which has been spent, Superfund Trust Fund, which has been spent, Social Security Trust Fund, which has been spent.
It's not in a lockbox. I thought Algo was in a lockbox.
Yeah, right.
Remember that one?
Yeah, I mean, it's all invested in treasuries. Now, investing these trust funds in treasuries is very much like you borrowing money from your IRA and going on a drunk.
Yeah.
You could put an IOU in there, but you've already spent the money.
Yeah.
Now, I think I know the way out of this. I think the way out will be twofold. I think they'll inflate away the net present value of the off-balance sheet obligations, which is to say that they will pay the old folks like me back with inflated dollars. And I think that they'll also probably have to do, a series of legislative defaults, which is to say they'll have to say to Social Security recipients, at the time Social Security was initiated, it was to provide poverty level existence to people over 65, when the average life expectancy of an American male was 64. That was a promise you could keep.
Yeah.
I think they're going to have to raise the eligibility level for Social Security to say 75 or something like that.
From the current 67 or whatever it is. Yeah.
This will be politically very unpalatable,
Yeah.
but it's going to have to happen, I think. I think similarly, there are going to have to be Medicare and Medicaid reforms. And it's going to be interesting if the country has a strong enough survival instinct to cause all of this to occur.
Yeah. And that's why we all invest in silver and gold, just because
it's self-defense.
If they're inflating it away, best way historically speaking, the best way we know for the common man to protect a little bit of something. But Rick, we've kept you for almost an hour now. We really want to thank you for giving us so much of your time.
Yeah, thank you, Rick.
Always a pleasure, gentlemen. By the way, I indulged in a little bit of graffiti in downtown Vancouver with the Wall Street Silver Canadian dollar decals on various public places in downtown Vancouver, much to my amusement.
Did you get any selfies for me?
I wanted to. They're too small. I tried to, but I'm not good enough with the camera. And the copies the guy gave me were sort of dollar size, so they don't come up in the camera well. When I return to Anacortes, I have that big one, which I'm going to post and take a picture of myself before somebody plasters it over.
All right.
But good. I did want to renew my offer to your listeners, which is to say, any of your listeners or subscribers who care about my thoughts on uranium stocks or silver stocks or any resources are invited to visit a website, sprottusa.com/rankings. List your natural resource portfolios. Please no cryptos, please no tech stocks, please no pot stocks. I'll rank them 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues where I think my comments might have value. For those listeners who mentioned charts in the question and comment section, I'll include the Barron's Gold Mining Equities Index, which is the best visual tool of bull market behavior in precious metals that I've ever seen. And I'll also include a 100-year commodity chart, which will talk about relative price levels of commodities relative to other asset classes going back 100 years. Once again, sprottusa.com/rankings.
Well, on that note, Mr. Rick Rule, thank you very much.
Always a pleasure, gentlemen. I look forward to doing these again. We're headed into, I think, both interesting and good times for us.